And I'm happy you brought that up, Jim, because you're absolutely right. The stock market is painting one picture, but the economy is telling us something different. So what is the real truth here? And that leads me to my other point about the debate of inflation versus deflation. And I know you're one
Yeah.
of the few experts out there saying actually, the Fed wants an inflationary environment, but they might not get it.
So first of all, the idea that money printing causes inflation is just not true. Now, everyone believes it's true. The monetarists, the Milton Friedman followers, the Austrian economists, even the neo-Keynesians say, yeah, if you print a lot of money, you get inflation. It's not true. And just for empirical evidence, I don't just say things like this without backing them up. Between 2008 and 2015, when they ended, 2014 when they ended QE3 at the time, the Fed expanded its balance sheet by almost $3 trillion. And we never had inflation. We never had serious inflation. You get 1.5%, but we never had serious inflation. The whole time the Fed had a target. This is 11 years if you want to go all the way to the end of the expansion in 2019, technically February 2020, 11 years. And the Fed never hit their target of 2%. A couple months, yeah, but not on a sustained basis, and certainly nothing above that. So I like to say it's a sad day when the Fed wants inflation and can't get it, and they do want it. So now they've come up with a new monetary policy. They've sort of, as I say, given up on the money printing thing. They say we're just going to let the economy run hot. We're not going to worry about money supply as much. We're just going to basically let unemployment drop, hopefully, and let inflation go. And if it goes above 2%, we're going to let it stay there for a while. So the below 2% and the above 2% kind of average out to 2%. That's new. Here's the problem. You can say it. You can take a vote and make that your policy. It doesn't mean you can make it happen. They failed for 12 years or 11 years. Why do we think they're going to succeed now?
So you mentioned gold before, Jim, and a lot of investors are concerned with the metal because we're seeing these ebbs and flows, this volatility with the metal. But I want to bring up one tweet you recently tweeted, and I'm just going to read it here. You say, reminder, when stocks tank, gold goes down as leveraged players sell gold for cash to meet margin calls on stock losses and other liquid positions. Once it's down enough, the strong hands pounce and gold rallies again. So I think that's a really interesting point, and I think a lot of people forget this is a similar pattern we saw in '08. Tell us more about this, Jim.
Sure. I like to say there are two kinds of buyers of gold or investors in gold. Generally the strong hands, pardon me, the strong hands and the weak hands. The strong hands don't use a lot of leverage. They use cash or capital. They're in it for the long haul. They're not day traders. They're, I watch the tape because I'm an analyst and I do a lot of interviews about it and I write about it. But I'm not a day trader. I don't get too euphoric if gold goes up. I don't get depressed if it goes down. I know where it's going in the long run. It's going to the kind of neighborhood of $15,000 an ounce. But that doesn't have to happen next year, even the year after. If that's the trend, then I like to remind people if it's going to $15,000 an ounce, which it is, it's got to go to 3,000, 4,000, 5,000, 6,000 along the way. So that's the long-term trend. So I don't worry too much about the wiggles. But yeah, as far as the stock market is concerned, and this happened, you're right, it did happen in 2008. I remember the worst part of it in 2008 in September, October, November, when the stock market was absolutely crashing, gold was going down. And I was getting all these calls, hey, Jim, gold's safe haven, how come it's going down? Well, what happens is in a liquidity crisis, everybody sells everything, especially the weekends. If you're leveraged, and you're in the gold futures market and you're long and the market's collapsing, you got to sell, you got to get out, you got to cut your losses. But also if you're losing money in stocks and you're losing money in mortgages, which was the case in 2008, today, as we saw since September 2nd, the market's down substantially. People get margin calls. If you're a leveraged player, you got to either come up with cash for the margin or you have to sell your position, which makes it worse. So what people do is they sell gold to get cash to meet the margin call on the stock losses, or they're on the wrong side of the gold market and they're leveraged and they just sell to cut their losses. So it does go down. It's highly predictable, but the strong hands are waiting. It's like if you've ever seen a lynx or a mountain lion hunt, they don't stalk their prey. They just wait. They sit there and wait and then they pounce.
So would you put Buffett in that category?
Well, Buffett's a little different. I think he did buy big stake in Barrick Gold Mining recently. I think he's more of a fundamental. He's not a market timer, certainly. I don't think he's much of a technical analyst. He is a fundamental analyst, but he saw something. Yeah, I would put Buffett in the category of strong hands, but Buffett wasn't around. But he was around, but he wasn't buying gold in 2008. He wasn't buying it in 2015 when the stock market went down sharply. But if you, again, look at every one of these instances, Danielle, you'll see that the immediate reaction gold was down, then it finds its footing, and then it goes straight back up again. I fully expect that to happen again.
So are you defining central banks as the strong hands?
Yes. Now, you have to pick and choose your central banks. Who are the buyers? Well, Russia and China, we know they've both tripled their gold reserves in the last approximately 11 years. But Vietnam, the Philippines, Mexico, Kazakhstan, they're all buying gold. And more importantly, the central banks with the larger holdings have stopped selling. Now, the Swiss National Bank, the US Treasury, the Bank of England, they're not in the market buying gold, but they're not selling. And they had been for really 30 years between 1980 and 2010. They had been net sellers the whole time, not the United States. An interesting thing about the United States, the US gold supply went from about 20,000 tons in 1950 to 9,000 tons in 1970. Then there was a run on the gold bank. It dropped even further. That's when Nixon shut the gold window in 1981. But the US still dumped gold alongside the IMF between 1971 and 1980. But 1980, we just stopped cold. The US gold supply today is almost exactly what it was in 1980. But what we, the United States, did is we got everyone else to do our dirty work. So what does that mean? The UK sold over half their gold in the late 90s. The Swiss National Bank sold 1,000 tons in the early 2000s. Canada sold all their gold. You and I have more gold than Canada because Canada has zero. If you have one coin, you have more gold than Canada, et cetera. So, and the IMF sold 400 tons in 2010. So the US didn't sell any more gold after 1980, but we were getting everyone else, again, Canada, Switzerland, UK, IMF, and others to sell their gold. Finally, they said stop also. There was almost a referendum to stop this happening legally in Switzerland and so forth. So everyone else stopped selling gold. So now you have one group of central banks who are buyers, another group of central banks who are just sitting tight. So that increases demand. Supply is flattish. If you look at global mining output, it's been pretty flat for about 5 years. And I talked to miners and people very close to the ground. They say it's obviously going to go down in 2020, partly because of COVID. Because mines are like any other business. If you have a pandemic, you have to shut it down. So supply's going down, demand's going up. I don't have to tell you what that does to price.